If you're a contractor and your spouse earns 250, 300, or even 400K on a W-2, you might be overpaying taxes by six figures every year. And most construction contractors think buying a rental fixes the problem, but that's not always the case. Today, I'm going to show you how leveraged depreciation and accelerated depreciation actually work, and how contractors can use them strategically to reduce a massive W-2 tax burden. So let's get started. So if you're new to the channel, welcome. My name is George. We talk all things accounting for contractors here. So here's a typical contractor household. Husband runs a construction company, wife earns a 250 to 350K W-2. Business is profitable and total household income is 400 to 600K. Husband and wife look at their tax bill once the year's ended and think there's got to be a better way. They buy one rental and nothing really changes. And why is that? Because they misunderstand how depreciation works and they don't approach it strategically. So if this sounds like your situation, feel free to book a strategy call. Our link is down in the show notes. We only onboard a few contractor clients each month due to capacity. So let's talk about the strategies here in this very simple scenario, what worked and what didn't. First off, buying one rental isn't enough. Let's say you buy a $500,000 duplex. Assume for tax purposes you split the value $75,000 to the land and $425,000 to the building. The residential property depreciates over 27 and a half years. So you take 425,000 divided by 27.5, and that gives you just over $15,000 of depreciation each year. And if you're in a 40 to 45% combined tax bracket, that saves you about $6,000 to $7,000 per year. Now, was this helpful? Sure. But does that offset your $120,000 tax bill? Obviously not even close. So what's the main tax strategy that most contractors miss in this situation? Depreciation is based on purchase price, not how much cash you put down. If you buy one 500K property all cash, you still only get that 15K per year depreciation. But now if you buy three 500K properties with 20% down payment, you get $46,000 depreciation each year. Same out-of-pocket money, but triple the depreciation. Because now you're depreciating 1.5 million instead of 500K. That's a material difference, and this is where strategy begins. We kick it up one notch and we go to accelerated depreciation. Instead of spreading deductions evenly over 27 and a half years, a cost segregation study breaks the property out into components. Appliances, flooring, electrical systems, cabinets, landscaping, fixtures. Some of these components qualify for 5-year depreciation, some 7-year, some 15-year, and so on. So that allows you to front load a lot of the depreciation. So instead of $46,000 annually, you might generate $150,000 to $300,000 of depreciation in the first year alone. But here's where most contractors get it wrong. Rental losses are typically passive. Passive losses don't offset W-2 income unless you qualify as a real estate professional or you structure it as a qualifying short-term rental. That means 750 plus hours per year, more time than any other trade or business, and proper documentation if you want to qualify as a real estate professional. And this is where strategy really matters. Because if the high W-2 spouse qualifies, or if the contractor shifts roles strategically, the accelerated depreciation can potentially offset your active income. When it's done correctly, we've seen contractors offset 6-figure of taxable income. Done incorrectly, you get deductions that carries forward. So what are some common depreciation myths? Number one, I only depreciate what I put down. And that's false, it's based on purchase price. Number two, buying all cash is better. And that's not necessarily true. Leverage often increases your depreciation potential. Like buying several properties gives you more depreciation than just buying one. Number three, depreciation only works if the value of the property goes up. And that's wrong. It's based on cost, not current value. So when done right, what does this look like strategically? Spouse earns 300K W-2. Construction company profits 200K. Total household income is 500K. Instead of buying one rental with cash, they use leverage, acquire multiple properties, perform cost segregation, and structure their qualification correctly. So now depreciation isn't 15K, it could be like 200K in year one. That can significantly reduce taxable income if structured properly. So again, this is not YouTube DIY strategy. Real estate professional status has strict IRS tests, and so does the short-term rental strategy. Bonus depreciation rules change and cost segregations must be engineered correctly. So if you don't plan this proactively, you're just buying rentals, not building a tax strategy, and there's a big difference. There's a lot of wealth to be created and preserved in real estate when everything is done correct. So again, if any of this applies to you, our calendar link is down in the show notes. We only onboard a few clients per month. We try to give everybody the due attention. So if your household income is north of 400K and you're staring at a painful tax bill, book a strategy call. Even if the tax year is over, we'll see if there's things we can do. So I hope you found this helpful and see you in the next one.